My name is Big Mike Zlotnik, and welcome to Tempo Family. We're all about helping you find great, predictable, reliable, conservative investments in commercial real estate. If this sounds like the kind of a journey you like to take, join our community by subscribing. Let's do this together. Can the world keep up with the breakneck pace of AI investment? Are we really in a new era? Or is the history about to repeat itself? While AI promise is extraordinary, investors should remember lessons from the past. Speculation and complacency, especially around revolutionary technologies, can be costly and dangerous. Next, let's cover Moore's Law meet the reality. For decades, tech leaders grew comfortable expecting ever cheaper, ever more powerful chips. But today, compute demand from AI is growing twice as fast as the Moore's Law says. That means annual global spending of $500 billion just to keep up with the demand. Are current AI investments sustainable unless revenues multiply just as fast? Can earnings match the hype? Many leading AI companies and investors are banking on profits doubling and tripling or quadrupling every year. But most businesses experimenting with AI still see little or no ROI in the bottom line. MIT reports that about 95% of AI pilots don't generate positive income at scale yet. The gap between expectations and proven returns is staggering. We are all spectators of this immense speculation. We've seen this dot-com rodeo before. AI company valuations are at historic highs, with some trading at P ratios usually reserved for science fiction. At the same time, Wall Street CEOs are warning investors to brace for heightened volatility and possible pullback. Meanwhile, the Mag 7 stocks now comprise 35 to 40% of S&P 500, meaning risks are increasingly concentrated in just a handful of tech giants. Let's have diversification debate. Some say diversification has lost its power, but as concentration risk rises, the market volatility returns. Disciplined value investing and true diversification are actually more important, not less. When everyone bets on the same few winners, downside risk only compounds. Where does value shine? Take a closer look at conservative strategies such as triple net industrial and necessity commercial real estate projects. For instance, many of these projects still offer 7 to 8% cash yields, 2 to 3% steady annual rent growth, and IRR targets in the mid to high teens. That kind of risk-adjusted reward is hard to find in speculative tech plays. These assets delivered on their promise for decades, even when stocks lagged. For example, some of the triple net REITs in 2025 are reporting cap rates of 7% plus, with 15% plus year leases and robust tenant credit. Now let's talk about the rotation when the music stops. When volatility strikes, capital flows where it feels safe. That's why when the stock and crypto bets come under pressure, institutional money and other individual retail smart money finds its way into reliable, yield-focused commercial real estate projects. History shows that when the music stops, value investing isn't dead, it's in high demand. In conclusion, the world is changing fast, but risk and reward never go out of style. AI will transform industry eventually. For now, don't ignore decades of hard-earned wisdom. Balance, prudence, and asymmetric opportunity in value-driven commercial real estate can still be the cornerstone of any resilient portfolio.